Welcome to Tech Money Madness, your daily U.S. stock market podcast, April 22, 2026.
Glad to be here.
So, you know that feeling when you're watching a movie and the audio is just like a split second out of sync with the video?
Oh, yeah. It is incredibly disorienting.
Right. The actor's lips are moving and it makes perfect sense, but the words hit your ears just a fraction of a moment later. Suddenly, the whole experience is just off.
Your brain knows something is fundamentally misaligned, even if the picture itself is crystal clear.
Exactly. And that is exactly what it feels like reading through your market briefing for today. You look at one set of data, the company is absolutely crushing their numbers, and then you hear the reality of the trading floor just punishing them anyway.
It really is a market suffering from, profound cognitive dissonance right now.
It is. Massive, globe-altering events are colliding head-on with this boundless technological optimism. So our mission for today's deep dive is to decode this bizarre split-screen reality you are seeing in your portfolio. Okay, let's unpack this.
It is a phenomenal paradox we are dealing with in today's data. If you evaluate the landscape, the market is completely bifurcated.
Split right down the middle.
Yeah. On one hand, you have this relentless, future-focused tech euphoria. It assumes we are entering this golden age of productivity. But on the other hand, you have the heavy, inescapable gravity of present-day geopolitical reality just pulling everything down.
And the challenge for anyone trying to navigate this is that both realities are true at the exact same time.
Exactly. But they demand entirely different investment strategies.
Well, let's ground ourselves in the macro picture first, because if you just look at the broad strokes of the major indexes today, the video in our Out of Sync movie looks fantastic.
Looks great, yeah.
Large cap indexes saw some really robust gains. The Nasdaq 100 led the charge, fueled heavily by aggressive buying in the semiconductor space.
Right. Everyone positioning ahead of some major tech earnings.
Exactly. And we also saw the S&P 500 and the Dow Jones pull off solid recoveries from those lows that dragged us down earlier in April.
So if you stop reading there, the technology sector looks like the undisputed heavyweight champion of the global economy.
But then the audio kicks in and the tone changes completely.
It really does. The counterweight to all of that Silicon Valley optimism is this massive looming shadow of geopolitical uncertainty. We have severe escalating tensions between the U.S. and Iran.
And this isn't just political posturing anymore.
No, it is a kinetic event directly impacting physical global logistics. The Strait of Hormuz remains closed. Global ship traffic is significantly reduced.
Which is wild.
Yeah, this is one of the most critical arteries for global energy and trade, and it is effectively pinched shut.
But wait. This is where the logic breaks down for me a bit. If I am looking at a tech rally driven by semiconductors, I have to remember that those chips don't, magically teleport.
Right. They are physical items.
Exactly. Nvidia and AMD need physical chips manufactured in Asia, loaded onto massive cargo ships, and transported across oceans. So how can the market logically decouple the two?
It is a great question.
It is like a company celebrating record software sales on a laptop with a dying battery. The software might be revolutionary, but if the physical power source fails, the screen still goes black. How is a closed global shipping artery not instantly derailing a Nasdaq rally?
The mechanism at play here is a profound time horizon disconnect. When capital flows into AI and semiconductors right now, it isn't valuing what those companies will ship next Tuesday.
Okay, so what are they valuing?
Investors are pricing in a 10-year vision of exponential productivity gains driven by artificial intelligence. They are projecting a future where enterprise software just fundamentally alters human output.
So they are looking way, way past the immediate problem.
Exactly. So when they look at a closed strait in the Middle East, they treat it as temporary, a localized friction, just a short-term logistical headache that will eventually be resolved by diplomacy or military intervention.
They are deliberately assigning a higher premium to a decade of software dominance than they are to a quarter of supply chain chaos.
Right. But as you hinted at, that time horizon disconnect explains the broad market. But when we zoom in on individual companies, the logic falls apart completely.
It really does. The market punishing ServiceNow today is the perfect example of how fragile this tech optimism actually is.
It is a fascinating case study.
Right. Here is a massive enterprise software company. They beat both their earnings and revenue expectations. By all traditional metrics, a total victory.
A blowout quarter.
Yeah, yet their stock sank a brutal 14% today. And the specific culprit cited in the briefing, a direct financial hit from the Iran war.
14% from a localized conflict.
Right. How does a domestic software company take a 14% haircut from a kinetic war on the other side of the planet?
It comes down to how global corporations handle panic. ServiceNow sells massive, expensive IT infrastructure overhauls to other massive corporations.
Okay.
So if you are a European manufacturing giant or an Asian logistics firm and your physical supply chain suddenly freezes because the Strait of Hormuz is closed.
Your immediate reaction is to preserve cash.
Exactly. You freeze all non-essential capital expenditures, that multi-million-dollar software upgrade you were going to buy from ServiceNow, you delay it.
Oh, wow. And Wall Street knows this.
Wall Street knows this. So even though ServiceNow had an amazing past quarter, investors dumped the stock because they foresee an immediate freeze in future global IT budgets.
So they are looking ahead to the frozen budgets, not back at the quarter.
Right. What we're seeing is the rise of an immunity premium. Investors are no longer just buying growth, they are demanding geopolitical armor.
Geopolitical armor, I like that. And that concept of an immunity premium completely reframes what happened to IBM today.
Yeah, let's talk about IBM.
IBM reported massive 51% growth in its Z mainframe hardware revenue.
51%, that is huge.
It is. For context, mainframe hardware is the heavy, expensive computing iron that massive banks and airlines use. A 51% jump means enterprises were buying up massive compute power, probably prepping for heavy AI workloads.
It is a phenomenal number.
It is. Yet their shares turned lower simply because IBM only maintained their forward guidance instead of raising it.
They proved they could sell the hardware, but they couldn't guarantee immunity for the rest of the year.
Exactly, which demonstrates a total psychological shift on Wall Street right now.
Past performance has been entirely stripped of its value.
Yeah.
You can put up 51% growth in a mature hardware line, but if you cannot promise that the next quarter will be insulated from global conflict, inflation, and supply chain collapse,
Your stock is going to get punished.
the market is projecting peak fear onto forward guidance. We saw the exact same mechanism hit Chubb today, too.
Right, the insurance giant.
Yeah. They blew past their earnings expectations, an undeniable win on paper. But investors immediately dumped the stock because they spotted early faint signs of a softening property insurance market.
It is just relentless. And Tesla is kind of the inverse of that same chaotic logic.
How so?
Well, they actually missed their top-line revenue expectations. They didn't sell as much as analysts wanted, but they beat profit forecasts because their auto margins jumped. They figured out how to make more money per car. But the stock still underperformed.
So you might be sitting there looking at your portfolio, seeing an earnings beat for ServiceNow, massive hardware growth for IBM, and better margins for Tesla, and wondering why all of them are getting punished.
The frustrating reality for anyone allocating capital right now is that a great quarter looking backward cannot protect you from a murky forecast looking forward.
When a massive geopolitical event is unfolding in real time, institutional money models the worst-case scenario for the next quarter, regardless of how sterling the last 90 days were.
They want companies to prove they are bulletproof against systemic macro shocks.
Well, but if the market is obsessing over systemic macro shocks, that forces us to look under the hood at the underlying plumbing of the economy.
Because right now, that plumbing looks incredibly fragile.
It really does.
The briefing notes the entire U.S. economy is holding its breath for key inflation data to dictate what the Federal Reserve will do with interest rates.
Always a tense moment.
Yeah. But there is a massive debate happening at the highest levels of economic tracking about how we even measure that pain. Bank of America economist Aditya Bave is actively warning that Kevin Warsh's preferred method for measuring inflation could completely backfire on the Fed.
This is a critical debate about the instruments we use to fly the plane, essentially.
Break that down for us.
Sure. So Kevin Warsh, a former Fed governor, has historically advocated for inflation metrics that strip out highly volatile categories, specifically food and energy.
Right, the core inflation argument.
Exactly. The logic, traditionally, is that energy prices bounce around too wildly based on temporary events. So removing them gives the central bank a clearer picture of structural inflation.
But if we strip out energy during a Middle Eastern conflict that has literally shut down global shipping lanes, aren't we just intentionally blinding ourselves?
That is the big question.
The pain everyone is feeling right now is heavily tied to energy. If the Fed uses a metric that filters that out, they are basically putting on a blindfold to walk through a minefield.
That is precisely Aditya Bave's warning. During a massive supply-side shock, Traditional models that rely on historical smoothing or exclude volatile sectors become incredibly dangerous.
Because they miss the actual crisis.
Right. If the Fed looks at a sterilized metric and concludes, well, inflation is tame, they might hold off on cutting rates. Meanwhile, out in the real economy, businesses and consumers are being suffocated by an acute, sudden spike in fuel and transport costs.
Relying on a flawed academic metric during a physical geopolitical crisis practically guarantees a massive policy error.
And we are already seeing the very real, very physical impact of those energy costs tearing through corporate balance sheets, specifically in the airline sector.
Yeah, the airlines are feeling it immediately. Southwest Airlines is officially forecasting their quarterly earnings will come in below estimate.
And they're pointing the finger directly at higher fuel costs.
Exactly. And at the exact same time, the Trump administration is in advanced talks for a rescue package for Spirit Airlines.
The through line is undeniable there.
A closed strait in the Middle East means constrained global energy, which means jet fuel prices spike, which instantly threatens the survival of domestic airlines operating on thin margins.
It illustrates how rapidly a localized geopolitical event transmits into domestic economic distress.
It is all connected.
But the ripple effects aren't entirely negative across the board. The same fear that makes jet fuel expensive is simultaneously manipulating the U.S. housing market in a very counterintuitive way.
Yes, the one bizarre bright spot in all of this macro gloom. Mortgage rates actually sank again today, and homebuyers immediately jumped back in, driving a notable rebound in mortgage demand.
It sounds crazy at first glance.
How does an international crisis make it cheaper to buy a house in the American suburbs?
It comes down to how institutional capital seeks shelter. When geopolitical panic sets in like a war threatening global oil supplies, massive pension funds and institutions take their money out of risky assets.
And they buy U.S. Treasury bonds.
Exactly, which are considered the safest asset on Earth. When massive amounts of capital flood into bonds, the yield on those bonds goes down.
And because U.S. mortgage rates are heavily influenced by the yield on the 10-year Treasury.
A flood of terrified global capital buying American debt inadvertently drives down the cost of a 30-year fixed mortgage in Ohio or Texas.
So, terrified institutional capital fleeing a war zone is effectively subsidizing suburban American homebuyers.
Basically, yes.
That is wild. But if we want to talk about true behind-the-scenes panic, we need to look at what is happening with global central banks.
Oh, the swap lines, yes.
The White House had to issue a formal statement today clarifying that the United Arab Emirates did not request a currency swap line. However, Scott Bessent, a highly prominent investor, is publicly claiming that many U.S. allies have actively asked for currency swaps to survive the turbulence from the Iran war.
To understand the gravity of that rumor, you really have to understand the mechanics of a currency swap line. It is not a standard financial tool.
It is an emergency economic lifeline, right?
Exactly. It is essentially a direct pipeline of U.S. dollars provided by the Federal Reserve to a foreign central bank. The global economy trades oil and most major commodities in U.S. dollars.
Right.
If a country's local currency begins to collapse because investors are fleeing the region, they suddenly cannot afford to buy the energy they need to keep their country running. So they ask the Fed for a swap line to artificially inject dollars into their system to prevent a total sovereign default.
It is the geopolitical equivalent of asking your neighbor to run an extension cord from their generator to your refrigerator right as a hurricane makes landfall.
That is a perfect analogy.
Nobody wants to publicly admit they failed to prepare, but behind closed doors, everyone is begging for power before all their food spoils.
And the fact that the White House felt compelled to publicly deny the UAE request, while well-connected investors are leaking that multiple allies are asking for it, tells me the situation is much worse than the official narrative suggests.
The whisper network in global finance is rarely wrong about systemic stress.
No, it is usually spot on.
The existence of these rumors is a massive indicator of severe liquidity crunches happening beneath the surface. It proves that while the Nasdaq might be hitting highs on AI hype, international central banks are desperately scrambling to secure enough hard currency just to keep the lights on.
Just keep the supply chains funded over the next 90 days.
Right. And with all of this capital fleeing to safety, whether it's into U.S. treasuries or begging the Fed for dollars, it completely recontextualizes the extreme market movers we saw today.
Let's look at those.
Look at United Health Group jumping over 7%, making it a top gainer. That is not an accident or a sudden passion for health insurance. That is terrified capital hiding in a defensive domestic healthcare stock that does not rely on the Strait of Hormuz.
Exactly. Conversely, General Electric dropped over 5.5%, and RTX took a hit of over 4%. Those are our top losers.
Heavy industrial and aerospace companies.
Highly sensitive to complex global supply chains.
And then you have Microsoft, Amazon, and Tesla remaining among the most active stocks today. But the underlying theme is clear.
The market is aggressively sorting companies based on their exposure to the physical world.
Yeah.
If your business model requires moving thousands of physical parts across hostile oceans, capital is fleeing your stock. If your business model is entirely domestic or fundamentally essential regardless of the economy, like healthcare, capital is rushing in.
It is a pure defensive reshuffling of the deck. But companies can't just pause their businesses until the geopolitical storm passes.
They still have to build things.
They still have to attempt to grow. The briefing outlines some major milestones today that show a distinct pivot towards something companies can actually control.
Execution.
Execution. Rivian just hit a massive production milestone for its R2 electric vehicle, getting it ready ahead of customer deliveries.
A huge physical win.
Boeing's CEO publicly declared all systems are go to aggressively increase 737 production, which is already helping narrow their staggering financial losses. And BMW gave the entire auto sector a shot of confidence by announcing they have absolute no intention of dropping sedans, committing firmly to their core manufacturing base.
Execution is exactly the right word here. When the macro environment is this chaotic, the immunity premium we discussed earlier doesn't just apply to software.
What else does it apply to?
It applies to physical competence. Boeing, Rivian, and BMW are proving they can manage the sheer physical complexity of an assembly line despite the global headwinds.
In an environment where the supply chain might break at any moment, proving that you can physically source, assemble, and deliver a vehicle or plane becomes a massive competitive moat.
The market is rewarding companies that put their heads down and control the controllables.
And we're seeing that exact same philosophy applied to executive leadership today.
No, the CEO shakeups.
Yeah, it is not just about studying the assembly line, it is about studying the C-suite. Microsoft's LinkedIn just named Dan Shapiro, a longtime internal executive, as its new CEO.
An internal promotion.
Right. And then Lululemon went outside, but went big, naming former Nike executive Heidi O'Neill as its new CEO, effective in September.
Promoting Shapiro, who intimately knows LinkedIn's internal culture, or poaching a battle-tested veteran like O'Neill from a massive global brand like Nike, are deeply defensive, stabilizing moves.
During a bull market, you might see boards take risks on visionary outsiders to disrupt the company.
Exactly. But during a period of intense global volatility, boards want seasoned operators who know how to navigate a crisis without sinking the ship.
It is corporate battening down the hatches. Okay, here is where it gets really interesting. Because we have talked about the flight to safety, the panic over supply chains, and the focus on execution.
Right.
But the briefing highlights a detail that feels like a massive contradiction. Nvidia is currently trading at what analysts is calling a rare discount, right as its next massive AI supercycle kicks off.
It is a fascinating dynamic.
If Nvidia is the absolute undisputed engine of the technological future, how is it trading at a discount? Is the market so completely distracted by the Middle East and interest rate panic that it is fundamentally mispricing the most important company of the decade?
This is the ultimate stress test of the time horizon disconnect we started with.
Okay.
Yes, Nvidia represents the future of enterprise productivity. But Nvidia still lives in the physical present. To build the infrastructure of the future, they need rare earth metals, they need Taiwanese fabrication plants, and they need open shipping lanes.
The physical reality catches up.
Always. The discount exists because the market is finally realizing that even a technological juggernaut cannot completely escape the gravitational pull of global macroeconomics.
The market sees the currency swap rumors, the inflation data, the war in Iran, and it applies a universal risk discount to everything.
Everything, even Nvidia.
So, even if investors believe Nvidia will be a $10 trillion company in 5 years, they are discounting the stock today because they aren't entirely sure how the global economy survives the next 5 months to get there.
Precisely. The discount is the mathematical representation of geopolitical fear. It shows the absolute limits of the tech euphoria.
You can build the most advanced artificial intelligence in human history, but you still have to navigate a world where a closed waterway can spike energy prices and freeze your clients' budgets.
You cannot escape the macro picture.
So to bring this all together for today's deep dive, we are looking at an April 22nd market completely defined by an intense, unresolved tension.
Very well said.
We have the unstoppable momentum of technology and AI fighting desperately against the gravitational drag of physical geopolitical strife. We saw earnings reports where spectacular past performance was actively punished because companies couldn't guarantee future immunity. And operating quietly in the background, we have a fragile economic plumbing system where inflation metrics are being hotly debated while central banks secretly beg for emergency currency swap lines.
The vital takeaway for anyone trying to navigate this environment is that reading the headline numbers is just no longer sufficient.
It really isn't.
You cannot simply look at an earnings beat or a revenue surge and assume the market will reward that stock.
Yeah.
To be genuinely well-informed right now, you have to look past the top-line revenue and deeply analyze a company's forward guidance.
And there's specific vulnerability to the global macro picture.
Exactly. You are no longer just evaluating a company's balance sheet. You are evaluating their geopolitical armor.
It is a harsh reminder that it doesn't matter how brilliant a company's product is, you have to look at the neighborhood they're building it in. And right now, the global neighborhood is experiencing a severe, unpredictable earthquake.
It really is. It forces us to ask a rather uncomfortable question as we look ahead. If physical geopolitical events like a localized shipping lane closure can instantly wipe out a massive percentage of a domestic software company's value, despite them hitting all their financial targets.
Like ServiceNow.
Like ServiceNow. Are we entering an era where traditional financial analysis is practically useless unless it is paired with a deep understanding of international relations?
It really makes you wonder if we can ever just look at a balance sheet in isolation again. It brings us right back to that movie with the audio out of sync.
It sure does.
You can focus exclusively on the video, the tech gains, the semiconductor supercycles, the earnings beats all you want. But until you find a way to reconcile those numbers with the chaotic, disruptive audio of our current geopolitical reality, the whole picture is just never going to make complete sense.
Absolutely true.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.